Hello traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Whilst I just let you have a look at the disclaimer, I'll just run through some of the key objectives of this webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or medium-term or even short-term themes that increase or decrease in importance over time. Our goal is to break down all the market jargon and complexities that you read about. So if you do have any questions, please ask along the way in the box and I'll hopefully answer them as soon as possible, or at least after the webinar finishes. This week, it seems clear that elevated inflation and increasing recession risks are the key drivers in markets, really following a week where several major central banks announced a hawkish pivot and interest rate hikes. Of course, it's those tighter US monetary conditions, which is one of the key reasons behind the equity sell-off, the higher dollar, and of course higher bond yields. So firstly, we'll look at global risk sentiment and the S&P 500 and Nasdaq charts, and we'll then take some time to review some of those central bank meetings from last week, including the Fed, of course, the Bank of Japan, and also the S&P, which we think is a major shift from them, and really interesting. Some opportunities potentially going forward there in the Swiss franc. And we'll of course look at the other associated majors to do with those central banks. It's just after 11 a.m. in London, so let's get to it. First of all, it's best to look at, as I said, global risk sentiment, and the S&P, as I said, and also the we'll also look at the Vix, the volatility index. It's really been another volatile week, really. The minor bear market rally to kick off Monday and Tuesday has seen equity markets really try to stem this grueling sell-off over the last few weeks. If you remember last week in the S&P, stock index recorded its heaviest weekly fall since the outbreak of the pandemic, with the index losing close to 6%, 5.8%, I think it was, lower. Its worst weekly performance since March 2020. And we've seen also then a firmness in safe haven bond markets, which meant bond yields, and remember they go in opposite direction to price, so bond yields have been keeping at the low end of last week's range. And we've also seen extreme volatility in other risky assets like cryptos, with another so-called stable coin losing its peg to the US dollar. That was really a weekend story, in fact, but there is a huge spotlight on the 20,000 level in Bitcoin. But it's the share declines really, it's grabbing all the headlines, of course, and they're really a sign of an increasingly gloomy global market outlook that we've been talking about over the last few weeks. And it was essentially those announcements by major central banks last week which suggests really that inflation concerns are trumping sensitivity around growth data and financial conditions. And we're really not used to seeing central banks contribute so significantly to market volatility in the way that the Fed, the Bank of England also, and the S&P did last week. And investors really are concerned about recession risks and clearly do not like the message being sent by larger than expected rate hikes. And it's this aggressive line really taken by these central banks that simply adds to the headwinds for both economic growth and equities and sentiment in general. The risks certainly of a recession are rising, while that key conundrum around achieving a soft landing, this hope for soft landing for the US economy, really does appear increasingly challenging. A soft landing, if you recall, is where the Fed or any central bank really is trying to manufacture a taming, if you like, in rampant inflation by rising interest rates, by hiking interest rates, but at the same time they're not trying to crimp economic activity, economic growth, such that it causes a slowdown, a sharp slowdown in economic activity and potentially that recession. We think it's worth looking at the Vix Index, probably I think for the first time really we've looked at it, known as Wall Street's fear gauge. For those of you who aren't aware, it's the most well-known measure of market sentiment. It measures expected price fluctuations or volatility in the S&P 500 index options over the next 30 days. So the VIX often soars when stocks plunge and drops on days when the broader market rallies. And if you think about volatility in general, well, that's essentially how fast prices change, and is often seen, of course, as a good way to gauge market sentiment. For the VIX, then, the long-term average is around 20, while above 30 denotes high uncertainty. And it's really sort of key to look at this index over time. It tends to be lower, as I said, in bull markets, and then higher when the bears are in control. And if we just jump back actually to the monthly, quite interesting to see. We can see, yeah, it shows historically episodes of extreme fear and crisis in the markets. So you can see the highs around the pandemic crisis in March 2020 when we spiked above 80 there. And if we flip back, you can see other crises, the Euro debt crisis, for example, there around 2011, 2012. And then obviously in 08, the great financial crisis, really where we spiked above 80 again. Very rare, of course, that we do that. But as I've said, around 30 really denotes uncertainty, and this is where we have been for the last few weeks, you see, way above that average, that long-term average of around, let's just pull back around, you can see around the 20 mark. So worth keeping an eye on the VIX, just as a gauge, really a general gauge as to where we are, where the market really is thinking the S&P might be, whether it's going to be a prolonged sell-off, if you like, over the next 30 days. Regarding the S&P then, just flipping back then to the weekly chart, we mentioned before, actually let's just pop to the daily first of all, we mentioned before that critical level, the May 2020 low was around 4114. Obviously we were trading around that, and then we rolled over, really couldn't break above that 4114 level, and rolled over quite sharply, of course, last week. And then the cycle low, the 20th of May cycle low at 3810, that was really crucial support, and we've dropped below that again last Monday. You see buyers attempted to actually climb above here last Wednesday, just before the Fed, I think, around the Fed actually, but the close lower saw more selling again, and that low from yesterday, in fact, at 3636 there. If we look on the weekly chart, you can see then that break of the 3810 level, and the close really sharply below that. Next support, where is next support? Well, it's key. It's probably, if we stay below this 3810 level, you can see some fib levels I've drawn on there. The 3815 sort of tallies with that 3810 level as resistance above. But next support, if we do drop below here, then we're going towards the 3,500 level. Many Wall Street commentators really speculating that that's a level they're looking at. You can see it's the halfway point between the pandemic low, the 2020 low at 2191, and then this year's high at 4818. So that 50% level, the halfway point, is 3505, tallying really with the that 3,500 level. And in fact, if I just drop down to the 200 week moving average, You can see as well that tallies again with around that level, that zone of around 3,500. So serious support there if we do drop below last week's low at 36.36. If buyers can step in, break the 38.10 level, then of course they'll be looking to go around back into this sort of zone. We can probably see it better on the, we can see it better here. There's that trend line support now, resistance just below the 4,000 level there. So tough asks really in this long-term downtrend. I've drawn also a bearish channel there, the downward channel. We were at the bottom, you can see, and then we've obviously buyers have stepped in, but sort of critical below this 3810 level. Also worth probably looking at the Nasdaq. Those are the futures, sorry, the S&P futures. You can see obviously looking pretty bleak today, reversing most of the gains from yesterday and looking towards the low in the futures, 36.36. The Nasdaq here, again, worth looking at. This is obviously taking the biggest hit of the main indices this year, down over 30%. Just flipping to the weekly, we can see the break lower as well. That we've mentioned, and also there's a band of support around the 12,000 level. Yes, again, similar to the S&P, really, we were holding above 12,500, but we couldn't really sustain a bid above, well, towards 13,000, and we've rolled over sharply in a few days, breaking through the sort of 12,000 level. The main low is first resistance. That was 11,492, 491 actually. We broke below there last week, just above 11,000, 11,068, and again we're trading around that level of 11,500. Potentially, if we break lower, then if we flip back to the weekly, we can see. To show you actually, well, we get some more fib levels actually, and on the weekly we've got the 200 week, the 200 week moving average around 10.8. 1.4 is the next target for the bears. That's on the Nasdaq. So we certainly think it's worth reviewing the central banks from last week. We had 4 major central banks. Really, the phrase came to us, there are decades when nothing happens and there are weeks when decades happen, and that was really suitable. A super volatile week for news, for central bank policies and price action. It wasn't a coordinated move as such, but it seemed really very coincidental. Thursday, we probably maxed out on that as markets digested the FOMC decision to hike rates by 75 basis points on the Wednesday night. Then we had the S&P shock decision to hike by 50. And then also some speculation that the market might sell some of its FX reserves to intervene in FX markets. We then had the Bank of England, which stuck to its 25 basis point rate rise, but toughened its forward guidance, and that kind of surprised the market intraday with quite a hawkish statement. And we also had some ECB stories around this anti-fragmentation tool, which would probably involve selling of other securities, and that sent the European core bond yield market, those yields higher. To wrap it all up, then Friday saw the Bank of Japan kind of reaffirm its commitment to super easy policy, in contrast to all the other really major central banks. So let's start really first with the FOMC. I'll just pull up actually one chart that, the CME Fed Watch tool that I think we've introduced before and that you guys should be used to now. But firstly, let's just recap on the Fed. It really ended weeks of speculation at the meeting last Wednesday, raising interest rates by 75 basis points. If you remember, 50 was baked in, but then we had this change of tact with the Fed blackout period, so speakers not being able to line up the markets for a bigger rate move after that. quite shocking US CPI figure. So we had the Fed essentially telling certain news channels that they wanted to hike by 75. I think it first came out in the Wall Street Journal, and then really markets priced in pretty quickly that bigger rate hike of 0.75 basis point. And that took the level of the Fed funds rate to a range of 1.5 to 1.75%, and that's the highest level since just before the COVID pandemic began in March 2020. It's also the most aggressive hiking cycle since 1994. And according to the dot plot, so the widely watched dot plot, which the US central bank uses to signal its outlook for the path of interest rates, so the benchmark Fed rate will end the year at 3.4%, 3.375% to be exact. So an upward revision from the March estimate of 1.5%. The hikes implied by that dot plot are around then 175 basis points of rate hikes between now and we get to that terminal rate. And Chair Powell certainly acknowledged the chance of another 75 basis point hike in July during his press conference. And we could see on the CME Fed Watch tool then, current rates, as we said, between 1.5 and 1.75, and we get a 75 basis point hike move priced in by the market now at 91%. So pretty nailed on that we're getting another rate hike of 75 basis points at the 27th of July meeting. And then if you look at the next meeting after that in the 21st of September, sort of split really now. So we get a 50 basis point move in September priced at 58, 59%. And then the chance of a 75 basis point move in September. So that would be the third on the trot. Sort of a 1 in 3 chance of that happening. So really quite sizable moves in these markets. We can see again if we pull down on the week, last week, a move of 75 basis points. Actually, let's look, just highlight a month ago there was 0 chance of a 75 basis point move happening. In the September meeting, that went up to 30% or so last week, and we're just sort of drifting above that 30% marker now. Really huge moves then in the Fed funds rate and in the futures markets, predicting the end, the terminal, rates for the next few meetings. It's really this more aggressive hiking stance. It does come at an economic cost. And there are cuts. If we just go back to the meeting last week, there are cuts in the bank's outlook for this year's economic growth, now anticipating just 1.7% gain in GDP, and that's down from 2.8% in March. And for inflation, remember the Fed looks at PCE, so personal consumption expenditures. That projection rose to 5.2% from 4.3%. Though core inflation, that's indicated at 4.3%, so up just 0.2% from the previous projection. So underlying inflation pressures, they really remain too high, and long-term inflation expectations are uncomfortably at high levels, according to the latest survey from the University of Michigan, and Chair Powell specifically mentioned this during his press conference. But the Fed, of course, is now strongly committed, I think the words they use, to get inflation back to 2%. And we think key in all of this, and for the market especially, is that the Fed is very realistic in its thinking that we'll have to basically slow down the economy quite substantially to get inflation down. And it's really walking into this prepared to see some economic pain potentially going forward, and in an increase in the jobless rate further down the line. Of course, going faster and deeper into restricted territory does imply a greater risk of a potential hard landing. Near term, the move higher in the Treasury yield curve, in bond yields, that really looks set to ensure mortgage rates jump over the next couple of weeks. And then obviously we've got this fall in equity markets, which is hurting both consumer and business sentiment, with knock-on effects for spending and hiring. Consequently, the outlook really for the domestic demand is already weakening, while the Fed is obviously hiking, and while the strength of the dollar as well is hurting international competitiveness and also squeezing corporate profitability. We just want to go back then. That was for the Fed really in the main highlights. Last week, of course, the data as well, that disappointed. US retail sales, they were weaker than expected. And we got the Philly Fed, a business outlook survey, that declined to its lowest level in 2 years. And we also got some housing data. Housing starts dropped by over 14% month on month. And we don't often look at housing data, but we think it's probably worthwhile just highlighting some of this data going forward. In fact, I think we get some this week. We found this chart which really highlights the pressures in the housing markets and how affordability is falling sharply. And you can see there from the last few years, then US home affordability is really dropping quite substantially. And it's this fixed rate mortgages, as we've said, those rates, especially in the 30-year, are now going higher. I think they're now above the pre-2008 global financial crisis level of 6%. And if you think again, that's come from sort of those lows around 2.6% just a year ago. And this is really potentially going to hit consumer confidence going forward, with some of these home sales figures potentially being quite grim and the market then taking notice. If we think residential construction, that accounts for around 2% of GDP, and housing transactions strongly correlate with areas of retail sales. And it's interesting, I think, that many economists sort of never expected the boom resulting from the COVID lockdown and easy economic policies to really be sustained. So the question really going forward is whether housing is kind of normalizing or whether it's experiencing a potential bust after this boom period that we've had. And kind of you can ask the same question about the economy overall. So whether the economy is settling into a sort of post-COVID pace or potentially worse, and whether it needs to contract as easy money, easy liquidity, all that liquidity is drained from the system. Calendar-wise, today's Congress testimony by Fed Chair Powell, of course, is the main focal point for markets. If recent central bank comments are anything to go by, then the tone should be hawkish, as we've had a host of FOMC members backing the 75 basis point hike that we saw obviously last week. In fact, even we had Archdove Kashkari revealed he supported that move, and he would indeed endorse another 75 basis point move in July. Interestingly, I think on the flip side, we had George, another FOMC official, a known hawk, actually explaining her opposition to last week's hike, as large hikes may add to policy uncertainty. And given presumably the Fed, of course, had signaled 50 basis point hikes, that is, for June and July. But obviously, referring back to today, the pullback in rates that we've seen since before the FOMC peak does suggest markets can still be caught off guard, for instance, by Powell today, potentially keeping the door open for more than one 75 basis point hike, should data require it. And we also get more Fed speakers, I think, today. We get Barking, we get Charles Evans and Patrick Harker as well. Today, obviously, since this blackout, then all on the wires, all worth listening out for, as well as obviously Powell. Concerning the dollar, let's just flip to the dollar chart. If we do with the DXY that you can see here, that's the weekly chart, of course. Certainly then, if Powell backs up the firm hawkish Fed path, then the terminal rate price for next year, which is around 3.6%, that can potentially go back up towards its recent high, around 3.9%. That means really, and we have mooted it in the past about this potential pause or or slowing down in the Fed. Really, that was probably a policy error by Bostic, in fact. And the Fed really wants to, as we've said, really wants to ride out this major hump or protracted increase in the inflation cycle. And perhaps really we had Barkin actually, Richmond Fed President Barkin yesterday probably summed it up best when he said the Fed should hike rates as fast as possible without breaking anything. Probably easier said than done, but really this should all allow for the bid in the dollar to continue. Of course, we should mention spreads between different global central banks. Spread differentials are narrowing as those other central banks do tighten policy, but it's really likely, we think, that the Fed cycle has the most legs in it, as its economy actually went into the current inflation shock operating above capacity. So we can see really also, we should say, the global risk sentiment really at the moment, especially, of course, it remains shaky, and that will also help underpin support for the greenback, along with, as well, we should probably mention lingering concerns about Chinese, the economic outlook there. So as far as the DXY, I think just pulling back, upward revisions to the dot plot last week, of course, reminded the market of support for the dollar, and the greenback really should enjoy that as the Fed remains really in sort of early to mid stages of its tightening cycle. The May high, the previous May high was going back here, the previous May high was just above 105 there. We obviously dipped lower when bond yields moved lower, and then we've obviously moved higher through June, made a long-term multi-decade high actually in the DXY at 105.78. That was posted on Wednesday. Obviously we've dipped even lower, but we're still holding above this resistance zone that was and now support zone, 103.82. High from before in January 2017, you can see on the monthly, and then also the pandemic high from 2020 at 102.89. So that's kind of a support zone now, really, to prices potentially going back higher to challenge that recent cycle high, multi-decade high at 105.78. Of course, all eyes are on Powell this afternoon to see what he says and whether he backs up, of course, these bigger rate hikes. Moving on then, I think another central bank meeting really worth highlighting was the Bank of Japan meeting on Friday. Some called it refreshing, but I'm really not sure about that. The bank really of Japan, they're very much in contrast to the other major central banks around the world who are obviously tightening. So the BOJ kept policies unchanged in its policy stance of yield curve control. What does that mean? It means they're capping Japanese government bond yields, 10-year yields, at 0.25%. And that, of course, is a rate far below current market levels of government bonds in the rest of the world. And it also announced its daily operations to ensure that cap is maintained. Just thinking about that yield curve control policy then, really in order to defend that yield target, the Bank of Japan must buy, if you think about it, massive amounts of bonds, and thereby adding equivalent amounts of yen into the Japanese money market system. And this has obviously contributed to a record weakening of the yen. And really, there's an interesting connection here to Fed monetary policy, because the more the Fed tightens, essentially, the more the Bank of Japan is forced to ease. Just then, stepping back to the meeting, Governor Kuroda and other members had previously publicly stated on several occasions that the Bank of Japan would retain its current accommodative monetary policy stance. And this week, even Prime Minister Kishida also confirmed his backing of yield curve control. And it really seems that policymakers do seem intent on supporting the economy to promote higher inflation expectations and wage rises. And indeed, we note that long-end Japanese inflation expectations have risen over the last year, but they still remain below 1%, and hence still far below really the Bank of Japan's inflation target of 2%. But also this, of course, going forward is quite a risky policy, as currency weakness that the Bank of Japan is encouraging is really quite costly for a nation so dependent on commodity imports. But it's this dynamic really between rate differentials that has obviously been a key in driving the yen lower. And we've got the chart here. So the dollar yen chart really hit 136.50, which was the highest level since October 1998. And then obviously more recently, we've seen new highs at 136.71. And I think, the market really has been betting continually on the yen weakness continuing. The Bank of Japan just stepping back. Actually, their statement did mention the need to pay attention to the developments in the FX market, but then Governor Kuroda downplayed this in his press conference. So going forward, of course, we'll get this jawboning from officials from Bank of Japan, officials, Ministry of Finance officials, and while they try to stabilize the exchange rate by referring probably to concerns over the sharpness of recent moves. But it seems really, as I've said, the Bank of Japan has quite a serious commitment to maintaining loose monetary policy, and that remains a priority over the falling yen. So from here, really, how does this sort of major trend in dollar yen correct? I guess you have to see US yields falling, but that doesn't really look likely with potentially the hawkish Powell today and the hawkish Fed in general. And you could also, I guess, you could see a potential correction in global yields if risk sentiment deteriorates, and that will potentially offer a breather to the yen, which we're seeing today. Regarding FX intervention, just to repeat really what I think we've said before, the history of Japanese intervention shows that really unilateral efforts rarely work. So we've seen it, I think, 7 times since the mid-1980s, and arguably it's only worked once in 1994. And you have to think as well, given US inflation is at multi-decade highs, then really a strong dollar policy has never been more desired by US officials today. Just looking at the chart then, dollar yen, the yen obviously remains this major victim in the high yield environment. The January 2002 top was at 135.16, which we can probably go back to here. Yep, you can see just there. We're going back to January 2002 around here. That top at 135.16, and obviously we made this new high at 136.71. I get the big figure right here, 136.71 very recently this week. If we're just dropping into the daily, you can see that push above the 135.16 level. That was the January 2002 top before, and we pushed above that just this week. So that will offer initial support really to this move higher, this break and push above the 135.59 previous June high. So that's sort of a zone, if you like, of support. And then I guess below there you've got that 130-134 high around the previous May highs. We dipped below that, tested it last week at 131.49, but then buyers stepped in again, and obviously we pushed higher the last few sessions. Markets really are obviously testing the Japanese authorities' determination to act in support of the currency, but really potentially 140 is the level most people, I think, in the market are looking at. If we just drop to the monthly, you can see, yeah, 140 big figure is the next level, and then you've got to go back to August 1998, 147.67. But pretty sure we would get very strong verbal intervention, if not proper intervention, around 140, but nothing holding it back to get there in the next few days and weeks potentially. Finally, I think it's worth highlighting the SNB, not a central bank everyone looks at every day, but we definitely think worth highlighting the moves. Sorry, last week. Just sorry, taking off that alert for some reason. Yeah, just highlighting the S&B and the move, the policy action we saw. Consensus had seen really the bank keeping the rate unchanged, but the bank, yeah, it pulled off this major shock, raising rates by 50 basis points. That moved rates from negative 0.75% to negative 0.25%. That former rate that had prevailed since 2015 and was the lowest in the world. And according to the press release by the S&B, the rate hike was aimed at countering inflationary pressures, as inflation in Switzerland had reached 2.9% in May, its highest level since summer of 2008. And that's higher than the S&B's objective of having inflation between 0 and 2%. And I think the upwardly revised inflation forecasts see the 2022 average at 2.8%. But then they fall back in 2023 and 2024 to 1.9 and 1.6%, I think. But it's really after years of fighting deflation. Inflation in Switzerland now is seen as too high, and the S&B has decided to act really quite abruptly and quickly, to the surprise of many in the market. The bank really is trying to take the lead, which is some change for policymakers there, who are known for being uber dovish, really, and many expected them to wait for the ECB to hike rates in July and September, but obviously they haven't done so. They're not wanting to play a potential catch up with a 25 basis point hike and then a 50, and that gives the S&B then flexibility depending on data and global economic and geopolitical events in the meantime. But also for FX, it was really a regime shift. I think many commentators are calling it. If you think back over the last 10 years, the S&B has seen really fighting deflation and warding off Swiss franc strength as one of its main objectives. Indeed, I think the S&B has accumulated over 800 billion worth of Swiss francs in FX reserves to fight any strength. But then on Thursday, we saw this reference to a highly valued Swiss franc disappear, and that need to redress it with intervention. And if we go back to late April, I think we highlighted in a previous webinar, the S&B told us that it wants to keep the real Swiss franc rate stable. And then the bank, obviously last Thursday, now no longer believes the Swiss franc is highly valued. And by raising rates ahead of the ECB, the S&B really is indicating that an appreciating Swiss franc is no longer that issue for them. And in fact, it's acceptable as the rise in the Swiss franc does allow, of course, inflation in Switzerland to stay more moderate than probably its neighbouring countries. So for FX, really that means this switch in the Swiss franc towards potential strength, or at least low volatility appreciation in the Swiss franc. And we've got the dollar Swiss franc chart here, really interesting chart. You can see after trading above parity in May, prices dropped sharply to 96 in just a matter of sessions, really. The 50-day SMA, that's the light blue line, that acted as quite good support as prices then rebounded on general dollar strength. We got above parity, above one again on Tuesday and Wednesday of last week, before this dramatic fall after the sharp rate hike. So where are we? We're above, we're below the 50-day moving average there. You can see it 97.20. So potentially that acts as a bit of resistance now to any move higher. We've also drawn in trend line support, which is where pretty much we're trading now, around the 97 mark here, and we're consolidating that fall really interestingly. After sharp fall, yes, you do generally get consolidation. Is that bearish consolidation before a move down again below the recent low, which is 96.19? If we do break below there, we get into more sort of congestion, if you like, around the 96 level. But potentially then, if we broke that low, 96.02, at the end of May, then we get back to 95. Really interesting chart and levels in some of the in dollar Swiss, and also if you check out some of the Swiss franc pairs as well, we think. Right, we'll wrap it up there. We've looked at quite a lot of detail, obviously global risk sentiment in general, and then also then we've gone through some of those, some of the major central banks, of course, and the implications for the majors, for the dollar, of course, the yen we've looked at, and the Swiss franc as well we've highlighted. We hope you have enjoyed this webinar, and please do register and come back to us in a couple of weeks' time for our next one. All the best and safe trading out there. Good luck.